Just a quick intro. So we're recording. We've had a couple of people, unfortunately, had to weren't able to make it today. But the idea is we're keen to get a insight and an update from Hamilton Lane. We've been endorsing in the past few months around the infrastructure, but more importantly, the private infrastructure space. So I think we'll be talking around about 30 minutes, and we'll be able to sit around and kind of talk a little bit about how we're using it and some of the opportunities we see in the idea and the thematic. But this really fits in well with the GP philosophy, growth and preservation side of things, where we see this as a very, very good risk reward asset class, where the downside is very, very modest and the upside is considerable. And infrastructure has now gone from, kind of roads and ports and a pretty vanilla kind of area to becoming much more dynamic around, data centers and AI and the infrastructure that's required for that, plus others. And also benefits from is a great asset class to have during times of higher inflation, which I think we're heading into, lower rates, benefits from that. So where we're going, we believe it's a good allocation within portfolios. The other side of it also, being in the private market, is that we still have the opportunity to get good value. I think at the moment, the big thing that's kind of swaying people with markets is just like valuation. There's a lot of good positive areas, but valuation is probably the area. How do we get our way around that? The ability to buy private assets helps a lot with that process. Yeah. And also, the thing that we love around it is that we're able to get kind of into the private equity type returns while only taking infrastructure type risk. For us, that's gold as part of an allocation within portfolios. Hamilton Lane group that we've been working for a period of time. I'll hand over to Phil to introduce the group. And I remember making the joke around a couple of years ago. They're probably one of the biggest managers that people maybe haven't heard of, but that's probably a bit harder to say now because they've been making some great ground through that process and period, and rightfully so given the results and what they've been able to do. So with that, I'll hand over to Phil, and if you can take it from there.
Yeah, no, thank you very much, Brendan, and thank you all very much for your time today. My name's Phil, joined with my colleague here, Hamish, from our Sydney office. We cover the private wealth market here in Australia. And on the line with us, we have TC Rolfstad. He serves as a principal within our infrastructure team, and also serves as the portfolio manager for this fund, based over in one of our US offices. Thanks very much for dialing in. I know it's late for you, TC. What we're going to do is cover a lot of the ground of why infrastructure, and dive into a few more of the points that Brendan just ran through there in terms of why we're excited about the opportunity. And then we'll talk a little bit more about some of the thematics we're seeing in the space and exactly how this fund works. But before we do that, I thought it might be helpful just to give a quick 2-minute overview of who Hamilton Lane is and where we sort of fit in within the ecosystem, because as Brendan said, we're probably one of the largest firms that you've never heard of. And there's a few stats here just to kind of put that into perspective. But what I might quickly do is just level set. I mean, think about any asset class. You have fund managers on one side and investors on the other side. Now, in the case of Hamilton Lane, we actually don't sit in either of those camps. What we're known as is an allocator. So we sit in the middle where we help these guys over here, the investors, typically pension funds, sovereign wealth funds, endowments, family offices. We help them access, diligence, and build a portfolio of these managers over here. Now, in the public markets, that's not as important of a role, given that all information is equally accessed. There's such thing as stock exchanges where any company you want to invest in, you can just invest in it with just a few clicks on your phone. But in the private markets, it's actually the complete opposite of that. It's a very inefficient market. Information is not equally shared. A lot of it is proprietary. You either have it or you don't. And then on top of that, access to deals often comes down to who you know, the relationships that you have in the market. So just because you see a company out there like, let's say OpenAI or SpaceX, some of these big privately owned businesses, just because you want to invest in it doesn't mean that you can. You actually need to be offered the opportunity to do it. And so that's where Hamilton Lane comes into the equation to really provide that access and that diligence. So a few stats here. This is all in US dollars. In AUD, it's about 1.4 trillion in assets under management and supervision. I think the more important number, though, to focus on this page is this one right here. So $34 billion. That's how much we deployed into the private markets last year alone on behalf of all these client relationships that we have. That number would make us one of, if not the largest allocators of capital in the world when it comes to the private markets. What does that afford us? Well, it gives us access to all these amazing managers who view us as one of, if not their the number one most important client that they have on their books. It also means we can throw our weight around in the negotiation process if it means getting access to preferential fees or terms. And we'll hear a few examples from TC today of where we've actually been given deals for free. It's very common what we see in the market where these managers enjoy working with us so much. They see us as such strategic partners that they're willing to give us access to free co-investment, which we can then package up into our own offerings and take to the market to you guys, where you can get a highly diversified multi-manager experience without that double layer of fees that comes with it. And so, yeah, you can see some of the names here with some of the GPs. The GP stands for general partner. It's just a fancy name for the fund manager. I guess the comment I'll make here is I'm sure you've all heard of firms like KKR and Apollo and EQT, Ares before. They're all very good firms, absolute sharpshooters of what they do. I'd say they're sort of jacks of all trade in the sense that they work across every industry in the world and almost every geography. Because they're so big, no one's really paying us that much to give them access to names like that. Where we really come into the equation is the mid-market space. And what I mean by that is looking at businesses that have enterprise valuations of sort of sub $2.5 billion in value. That represents about 98% of the deal flow and market out there. But what we find with the fund managers that operate in that space is they're not jacks of all trade. They tend to be masters of one or two. So what I mean by that is it'll just be a GP that focuses on water management facilities in the US, and they know that industry inside out. Or it might be a GP that just focuses on rail networks throughout Europe, whatever it might be. If they're top quartile fund managers, then usually they're going to have very long lines of investors waiting to get into their funds. And that's where Hamilton Lane comes into the equation to help even big pension funds and sovereign wealth funds around the world to basically open the doors to those sorts of managers, given we've been working with them for the last couple of decades. So hopefully that gives you a very high level overview of who Hamilton Lane is. If there's any questions at all on the firm, happy to answer them now. Otherwise, what I'll do is I'll pass over to my colleague TC to dive into our infrastructure platform within Hamilton Lane and the fund. Over to you, TC.
Perfect. Well, it's a pleasure to be speaking with you, and thank you so much for the time. I thought what we could do is talk a little bit, a layer deeper about us and our business and our infrastructure business specifically at Hamilton Lane. Today, this is a business that has about $83 billion in assets under management and supervision. We've been investing in the infrastructure space for about 25 years, which is really the entire history of the asset class. In fact, probably at the beginning of the 25-year period, it was a subset of the broader buyout industries. We have grown to a substantial footprint for many of the reasons that Phil highlighted today, having relationships with a broad cross-section of the general partner community, which is really important for us in sourcing and accessing investment opportunities. Today, we deploy about $6 billion of capital into the primary fund market. So there's really kind of three divisions that we would think about investing into infrastructure investments. And at Hamilton Lane, this is across our verticals, but specific to our infrastructure business. The primary piece, this is sort of the lifeblood of the general partner community. Think of those as the managers in this case that earn most of their fee revenues off of these primary positions. This is where they are typically building portfolios through drawdown structures over 3 to 4 year periods and holding those assets for as long as 10 to 15 years. We invest in that space outside of the strategy that we are running today, talking to you about and of your interest. But this is very important to us because it gives us a few advantages. One, it gives us a tremendous amount of data and information advantage. We know all these general partners. We have all the information on them. This is what allows us to unlock the points that Phil was mentioning about who are the best managers in a given sector, subsector, industry, or region around different infrastructure investment themes. This then also unlocks a lot of the co-investment opportunities. These are direct rifle shot investments into specific assets, platforms, or companies. They're investing in infrastructure themes. And we'll talk more about what that means for us in a moment, more specifically. But this is an area where we're able to invest on a fee-free basis typically. So this is very efficient for us in accessing these opportunities. And then we also do this with secondary market opportunities. So that's buying those primary positions a few years into their useful life. Sometimes there's an investor that comes into a 10+ year partnership and maybe a few years in needs to unlock liquidity, and they do that through the secondary market. And we're an active investor in that space as well. That overall deal flow between the co-investments and secondaries piece is running at about $150 billion over the last 5 years, about 40 billion in 2024. Today, we're already over 50 billion in 2025. So it continues to grow. And what's important here is we get to select a few opportunities, typically about 1% to 2% of that deal flow annually in terms of the investments that we invest in. So the top of our funnel is the bottom of our general partner relationships portfolio funnels. So very high quality, and we're only investing in, call it 1% to 2% of that each year. So very, very selective around the deal selection, which we then partner with portfolio construction. I think, yeah, so just a little bit about our track record. We've been investing in co-investments and secondaries going back to 2006, focusing primarily on core plus and value add. That's a term I'll define for you in a little bit. Really just means the intersection of stock and bond-like qualities in infrastructure space, and have generated returns north of 20% and 1.5 times on a combined realized and unrealized basis. About 20-25% of that is fully realized, with that performance skewing even higher on a net of fees basis. But what the metric I'm probably the most proud of is of our business is of our loss ratio. We've had a loss ratio of less than 1% over this time going back to 2006. We think in an asset class like infrastructure that should be underpinned by capital preservation, this is a very important metric. And if you look across the industry, this number would be in the mid to high single digits if you look broadly across the asset class. So we would differentiate ourselves on this way that we've been very successful in sourcing good deals with good capital preservation characteristics. I think we've talked a little bit about the bigger part of our firm at Hamilton Lane, where we've been investing in the private markets for 35 years. And for a long time, this asset class is one that was really highlighted about the closed-end investment markets, the drawdown funds. And more recently, and starting in 2019 for Hamilton Lane, we've been an active investor through the Evergreen portfolio offerings. These are very, I think, good options for investors that want administrative efficiency. Accessing the market allows for a very good compounding of growth. And we've done that starting with our Global Private Asset Fund in 2019 and adding successor strategies. Today, we have a number of products across not only private infrastructure, but private equity, venture capital and growth, and credit strategies with some other variants beyond that. Today, that sits at over $13 billion of assets under management across our strategies, and has been a very, I think, sizable growth area for us as a business. But I think what's important not only is the size and the scale and the history here, but it's the lessons learned and the I think, technical expertise about executing on evergreen strategies. And maybe that's a good segue to the next slide, where we talk about partnering not only our investment team, which is the individuals in the bottom left-hand side of the screen. This is the 30 individuals that focus every day on bottoms-up investment selection and deal underwriting, but as well as the folks on the right hand of the page. This is the portfolio management group. This is a group I work with quite often around building and managing the Global Private Infrastructure Fund. What's unique here is that managing liquidity, duration, cash management, et cetera, becomes a lot more important and much more complex in an evergreen setting. And this is something that we've done successfully going back to 2019 as a business. I think is a key differentiator for us as a firm compared towards the pantheon of offerings that are out there today. At the top of this page, you'll see a cross-section of individuals that are some of the most senior offices of the firm, lead various investment divisions of our firm as well. And they sit and orchestrate, oversee, and manage some of the strategic inputs and thoughts and constraints around managing our evergreen solutions, including the Global Private Infrastructure Fund. So that's a little bit about us. We've been doing this for a long time, have been developing a lot of scale. What I think is maybe the next segue here is to talk a little bit more about why we think this is an interesting asset class. We heard from the beginning some of the house views here. We very much align around these of why we think infrastructure is interesting for investors in their portfolio. And we'll just spend a moment here, maybe talking a little bit more about the data in this space. But before I get into the data, I think it's helpful to frame a little bit more about what we mean when we're talking about private infrastructure. When we think about it, is we think about it very asset intensive businesses. So this is owning wind farms, this is owning airports, this is owning rail networks. These are very asset intensive, essential businesses, typically have high barriers to entry and are often underpinned by long-term cash flows to high quality counterparties that allow these businesses to be very durable and generate not only stock or bond-like qualities, but stock-like qualities as well. And so that's part of the aspect of why this is a very good asset class from a risk-adjusted perspective, and that we've been able to generate as an asset class very strong returns, close to 10% annualized going back a number of years. It's one of the only asset class over the last 15 years that's posted positive returns every single calendar year. Not many can claim that, and we'll have to look at that in a moment. But it's doing so with very low volatility. And so we use this term called the Sharpe ratio, which is just simply thinking about your return divided by your standard deviation or your volatility. There's a couple more bells and whistles to it, but it's essentially thinking about your return per unit of risk. And we've observed over the last number of years that this has been about 1.75, which is as high as any asset class out there. There's really not many that have had this type of experience. The other benefit here is we sit next to public equity markets with very low levels of correlation to them. This is very helpful as you build diversification in your portfolio. So we have strong risk-adjusted returns, low levels of correlation. You put those together, it's very additive to an overall portfolio. We have other metrics here thinking about inflation hedging. I think it's worth mentioning here for just a moment that because these are asset-intensive businesses, they're have a replacement cost value. So this is kind of a real estate term, but if you think about as inflation goes up, it gets more and more expensive to replicate these types of businesses. But probably more importantly is they typically have long-term contracts with built-in inflation escalators for both revenue and expense items. And this is one of the reasons since we've gone back to 2022, where we've had rising inflation in many parts of the globe, we've seen infrastructure continue to march ahead while other equity asset classes have had periods of pullback. Many of them have recovered over that time, but that again speaks to the volatility metric. So I think we will talk just a little bit more about two simple examples, putting that to work in a portfolio framework. The first is thinking a little bit about the traditional 60-40 portfolio. Yes, so as we think about this, on the left hand, you look at a portfolio very simplistically, 60% broad equities, 40% broad fixed income, and you get decent returns, you get decent levels of risk. This is kind of probably not necessarily where most people live with their portfolios, but is somewhat emblematic of a traditional portfolio construction. What we've done here is just looked at if we added a 10% allocation to private infrastructure, taking 5% from equities and 5% from fixed income, we've improved the return over this time frame. We've reduced the risk, which has improved the return per unit of risk, which is again that Sharpe ratio metric that we pointed to previously. And so I think the point here, the simple point is just that over long periods of time, roughly 10 years here, this has been an added addition to a portfolio, both in return generation and volatility reduction. I think another way to look at this is just what the returns have been over year. The dark blue bars are the annual returns for private infrastructure. The shaded or the, I guess, outline bars, one is of broad public equity, the light blue, and then one is of, or sorry, that would be of the light orange, and then private infrastructure is an asset class, that's the light blue. You'll notice here that you've had similar returns to private infrastructure and the public side. You've had almost triple the volatility, and you've had periods where the public markets have been below zero in a number of years and above a number of years. Private infrastructure has been always above the line throughout this 10-year period. If we stretch this going back to 15 years, you would see the same case be true. We'll talk in a moment about why 15 years is a meaningful time change in the infrastructure market in a moment, but it's, I think, important to point out and how we think it's additive to portfolios. Pause there just for a moment in case there's any questions on that thought process. Happy to take questions too at the end, but if people have thoughts along the way, that's always welcome.
I think keep going. We might save it for the end.
Okay, perfect. So I think at a high level, we'll get a little bit more into the contours of our strategy. So again, Global Private Infrastructure Fund is an evergreen infrastructure offering focusing on asset-intensive investing in major infrastructure sectors globally, as it is a global asset class. We will do so by investing through a combination of direct equity co-investments, which we defined a bit at the front end. These provide that rifle shot opportunity in specific assets in a very efficient manner. And then we'll blend that with secondary positions, which provide a little bit more diversification, typically a slightly lower duration, which is important for managing liquidity in our portfolios. And an additive there is that secondary positions we're usually able to buy at a discount to their par value, which is a nice entry price or basis in coming to these opportunities. I think the quick analogy on that is similar to if you were buying or selling your home. If you were willing to take a 2 to 3 or 4 month process, fully market it and put it on the market, you would maximize the value in exiting a home sale typically. If you needed to sell your home tomorrow, you probably would be accepting a slightly lower price to move that liquidity position over time. And that's something we get to benefit from in the secondaries market. We can talk about that in more detail if it's helpful to you. But I think it's one of those things where those two components come together to create a very consistent return profile for the strategy. Moving ahead, I think we'll move maybe 2 more slides ahead, if you would, Phil. I think this is really important. These are some of the themes that we're seeing in the infrastructure asset class. As mentioned at the outset, some of the major macro financial driven industries and opportunities and themes are flowing directly through infrastructure as an asset class today. I think the 2 very obvious ones, really energy transition is still there. That's moving from the higher carbon to lower carbon fuel mix globally, moving for things from such as coal to wind energy, for example. But in the last couple of years, with the demand that we're seeing around the development and growth of data center activity globally, electron demand is growing exponentially in many respects, and is putting a tremendous amount of pressure on electron generation, broadly speaking. And so we think about that through natural gas solutions, which are I think an improvement over coal, solve for some of the intermittency aspects of renewables and partner well with them as we look to expand and generate additional electrons globally. So I think a theme here is power, and how do we get that to fuel data center and AI, as well as some of the onshoring and nearshoring of different industries and cryptocurrency mining, et cetera. These all require fantastic levels of power input. We mentioned it briefly, but the digitization theme, this is a huge theme in infrastructure today, which is helping fund the rollout and build out of data center capacity globally. What I think is important here is that there's parts of a data center and there's, in terms of financial ownership and risk management. The way we think about investing in this space is coming into a powered shell, essentially, and operating that asset, maintaining high levels of uptime for the tenants. This represents about 40% of the overall cost that is incurred for building a data center. The other 60% really comes from putting in the chips and the racks and the fiber optic networks, et cetera, that run inside of these shells. So our job for infrastructure, which is at a natural intersection of infrastructure skills, is bringing power to site, building stable sites and resources, and maintaining those complex assets over long periods of time. And so infrastructure is a huge solution provider in this space. But what's really attractive about it is, although it's growth oriented, you're typically not putting capital to work until you have a pre-contracted growth with a often high quality counterparty, such as a Meta or Microsoft or somebody of this nature, who's essentially signing their lease and contracting with you in advance of you putting significant capital to work. This is a place where you find the data center themes and target mid-teen returns. We measure them in IRR in the private markets, but think about that as a very healthy return objective. When you compare that to some of the valuations that you would see in the public market to participate in other allied industries, whether it be the publicly traded data centers or things like NVIDIA or Microsoft or other firms such as that, or much less trying to access it on the buyout or venture capital side, trying to buy into a valuation on OpenAI. These are phenomenal valuations. And so this is a much more conservative way and much more de-risk way, but to still benefit from some of these global themes. Related to this are still traditional infrastructure sectors around transportation, thinking about rail and airports, the movement of goods and people globally. This has been a major theme for a long time and will continue to persist. And then others that we think about are around waste and water opportunities, particularly in North America, the middle market, which is an area we focus, has been one where we've been able to find good opportunities in more traditional areas coming in at much more attractive entry valuations, sometimes in the single digits. And so I think that was one of the comments early. It's very true that there's parts of infrastructure that are relative to other opportunities you see globally today, very attractive with a lot of runway for value creation. And so we mentioned a little bit earlier the core plus and value add. This is getting a little bit into the inside baseball kind of terminology of infrastructure investing, but I think it's an important one for investors to be aware of. There's a spectrum of sort of risk within the broader private infrastructure heading. The lowest end of that would be core infrastructure assets. Think about this as being a big physical asset, such as I think a pipeline is a good example. You've built it, it's up and running. It doesn't need any expansion work done to it whatsoever. You've got a 10 or 20-year lease on it to a high quality counterparty. All you do is make sure that it runs and stays open and operates as represented. That's a single digit returning investment. It's a very low risk investment. At the other end of this spectrum would be investing into things where you're taking greenfield development risk. This is more speculative in nature. This is the build it and they will come mentality. That's not something we look to invest in through our strategy. It may also include things where you're taking direct commodity price exposure, merchant power price exposure, technology risk, emerging market risk. We like to live in between these elements where we have some component of those core pieces. Part of the business is built, cash flowing, generating revenues, but then we have upside through typically pre-contracted growth. So we made the example earlier about data centers being an example of this. This also happens in renewables areas of the market and other themes where there's a de-risked element to expanding these businesses. And so we don't need to bet on multiple expansion. We can really just focus on growing the profitability of these businesses to drive value creation. We don't underwrite multiple expansion, but it does find us sometimes, and we're always pleased when it does. I think one other contour here that's important, and I think it is one of the advantages of Hamilton Lane, is getting access to the middle market. We think in the infrastructure space, this is particularly important, is that majority of transactions in the infrastructure market. So the infrastructure market is about it's average about $1.2 trillion physical transaction market annually. But when we break down the enterprise value of those businesses, so that's effectively this like a market capitalization of these businesses, the majority of them, about 98%, transact at below a $2.5 billion enterprise value. However, the majority of general partners out there, many of those that are in the dark gray bubbles in the upper right-hand corner of the XY axis, are these groups that are raising 10 and 20 and even $30 billion of capital. They are really held hostage to transacting at that largest end of the market because that's really the only place that's efficient for them to deploy the scale that they've raised in terms of equity capital. As a result of that, those handful of deals, we've continually observed that the entry price multiples have continued to inch up as there's been more and more capital chasing a handful of deals. By comparison, there's a lot more liquidity and much more attractive entry prices in the middle market. We're still talking about 500, I'm using US dollars here, but 500 million US to call it 2.5 billion US is still a very wide aperture in terms of opportunities. There's still very sizable businesses. And yet there's a lot more in terms of levers to pull and buttons to push to unlock value creation. And then when it comes time to sell something in that size range, there's a lot more buyers to exit these opportunities. When you get to that very large end of the market, you're really beholden to the IPO markets or the public markets, which those windows come and go. And then you often have lockups on those shares for a couple of years post-sale. And so it's a less liquid part of the market, which for us, we think is more attractive, both for portfolio construction reasons, but as well as for the overall portfolio. And then I think just maybe touch a little bit on today, the portfolio. As we sit here today, we have performance now through August officially, and September will be out in about a week. With that information, we're sitting at about $900 million Australian dollars of assets under management in the strategy, having launched in February 2024. It's been very successful in the growth of the strategy. We're very proud of the performance that we've been able to generate over that time. The Australian dollar share classes will be about a 14% year-to-date return going through September. With good diversification in terms of the line items. We're just over 40 line items in the portfolio today, meaning various investments, a good cross-section of general partners, combination of co-investments and secondaries, geographic breakdown, and very much in line with where we were set out to build the portfolio. And so as we look at where we sit today after all this growth, we're very pleased with the way the portfolio sits. We continue to see a robust forward pipeline for deployment as we move ahead. And I think we're right on the mark in terms of being able to continue to deliver portfolio build out like this. I think I know we're probably just about 30 minutes here of commentary, so maybe I'll just focus on one or two case studies, and then we can take questions or go any other direction that makes the sense for this group. So I'll talk about Project Galway first. This is a bit of an interesting one in that it was one of the first portfolio positions that we put into the portfolio, which was the acquisition, the investment alongside Apollo. So Apollo is a mid-market infrastructure GP into a portfolio of data center assets in tier one markets with leases with AAA and AA tenant hyperscale quality counterparties going into these assets. It was funded by a family office based out of Texas that had been very successful in securing these leases and needed capital to help continue to fuel the growth and build out of that expansion. We came into the portfolio as a part of a structured solution, providing some mezzanine financing as well as some equity components. This portfolio, when we came in, was about a $2 billion enterprise value. And after 16 months of ownership, we were a part of the sale of the business to a group called DigitalBridge. DigitalBridge is a large cap private equity digital infrastructure specialist, and they bought it for about a $5 billion enterprise value. And so this is one of the first exits out of the fund, and I think is an example of some of the tailwinds in this asset class, as well as the ways that we can come into sort of these de-risk situations and partner with these small mid-market opportunities on their path to growth. The other one, maybe just to touch on quickly, is just Project Napoleon, which is a secondary position we bought of Ardian Infrastructure Fund 5. Ardian's a European blue chip infrastructure GP. They had a portfolio of about 13 underlying portfolio assets in traditional infrastructure sectors. We looked at this through broker channels, and I think the short story here is rather than transacting through the broker market, where this was actually a position that was trading at par value, we were successful in entering into a bilateral negotiation and an off-market deal with a relationship of Hamilton Lanes, where this group was an insurance company who valued speed of execution over maximum price discovery, where we were able to buy the portfolio at an 8.5% discount, which is a very attractive basis to come into a portfolio that was fully seasoned with total line of sight to the portfolio's assets. And that underwriting for that position is to generate about 1.7 times their money over the life of the hold. So we get about 15% of that upfront in that discounted position, but we've already seen a significant amount of income and appreciation post-investment in this position. And so that's been moving it forward nicely. So trying to give you an example of a couple of market themes, as well as a co-investment transaction and a traditional secondary transaction. So I'll pause there with kind of formal comments. I don't know, Phil and Hamish, if there's anything you wanted to highlight to round us out.
No, I mean, we can talk about just the structures we have in place as well, but maybe now's a good time to just open it up and see if there's any questions from anyone for TC.
I'll get into one. So in terms of the opportunity set ahead of us, like how strong or kind of, kind of excited are you around some of the headlines that we hear, i.e., Europe increasing their, spending levels around defence, etc., from 3 to 5% of GDP, and apparently 35% of that is allocated to infrastructure. It seems like it's a global focus with regards to the money going into that area, but what's the opportunity set like behind those headlines, I suppose, is what I'm asking.
Yeah, I think we'll have to see more of what the contours look like. Sometimes when you hear spend in that government context, it may be towards things that are infrastructure in nature, but it might be in areas that are difficult for an economic investor to unlock value. So it might be they're going to build a larger military base, or it might be they're going to put more road infrastructure into a certain area, or expand water capacities for strategic reasons of the nation. Those are harder things from an economic investor to participate in. But I think that there is tremendous opportunities in many regions globally today where we're seeing things around in Europe today. I think the themes around renewable generation continue to persist. As a theme, Europe is very keen to, I think, bring back more of their own energy sovereignty locally, and to, I think, they've learned through the natural gas that they were purchasing from Russia that that's no longer a long-term solution. So we have a pipeline deal that we're evaluating today that is involved with the LNG import-export terminals that are already built assets that are in strategic locations in and around Europe. So there's opportunities like that is a defensive move by them as a nation to be able to have more energy security and source energy from nations that they have, I think, are more allied with them and a stronger relations over those things. So I think it's definitely a driver of that. You also see things in the U.S. where policies around supporting various themes are very much in the headlines today. The White House is in the news supporting the acquisition of some currently decommissioned nuclear power plants, to think about it in a recommissioning manner, and putting an $80 billion support behind doing so. And nuclear is not something that we invest in through our strategy. It just doesn't fit for a number of reasons. I'm happy to unpack those, but it plays into the energy themes that the globe is working with, whether it's strategic or some of these data-driven themes.
Are there any areas of the infrastructure that you see a particular beneficiaries to AI and kind of cost out program and better efficiency, etc., more than others, or like significant standouts?
Well, I think we're definitely investing in, whether it's cloud or it's AI, that's definitely affected from both the power elements that we're investing into, because it's very data. I mean, that computation requires tremendous amount of data. I think Goldman Sachs is on the record saying it takes something like 10 times the power to do an simple AI search than it does to do a Google search. And so these things are just manifesting quickly in terms of the power demands that we have out there. So we're definitely seeing that directly through the data center space. We're also participating in opportunities in the fiber optic space or broadband spaces, where we're able to support the connective tissue, or whether that's getting that to commercial or residential premises. I think you have to be careful in the structuring in some of those. Fiber has been a mixed market, but there's certainly some major winners in that type of space. I think there's a lot of capital, just generally speaking, coming in around technology solutions, managed services. I think especially from the venture capital growth and buyout lens, which we certainly have colleagues at the firm that spend every day thinking about that. I think with respect to this mandate, that's a little bit out of scope. We typically be looking more asset intensive and a little bit more contracted in terms of the positions we're moving into. Hopefully I'm getting close to answering that question, but feel free to.
Yeah, and I was talking about the more traditional areas of infrastructure, but I think you've covered off on that. Okay.
Okay, wonderful.
Any question, Daryl, or anything around that?
Would it be helpful just to talk about the structures that we have in place as well for the local feeder fund? I mean, hopefully you've gotten a good sense from TC of our sort of heritage and our caliber within the infrastructure space. But on top of that, there's some other things that we're quite proud about with how we've structured the local feeder fund here. So firstly, this is one of the at least from what I've seen, the only global private infrastructure fund that's out there that does not charge a performance fee with the fund. So it's a very fee efficient way to get access to a very diversified portfolio of infrastructure assets. And these are all the same deals that the big, super funds here in Australia or pension funds offshore and, endowment funds are going into. We're going into the exact same terms alongside them. On top of that, something we're also quite pleased about is we've got two share classes available. One is a distributing share class. So, target returns to the fund are 10 to 12% net of all fees. But we also have a dual target of trying to provide around 2 to 5% in annual income from the fund. Now, if you wanted the income, then great, you can take it through the distributing share class. But if you have no need for income at this stage, you can actually go in the accumulating share class. And the reason why that's quite unique is you don't just get your distributions coming in the form of more units in the fund. Those units that you have actually increase in value. And so the reason why that's important is it just basically defers the tax that you'll have on the fund. So rather than paying tax annually, the tax it will come at the point of redemption. It's just a unique structure that we pioneered here in Australia, and it seems to be well received for people who want the exposure, but not necessarily the income that comes with it. And then finally, unlike the traditional fund structures that exist for private markets, where it's a 10-year lockup fund, it's a minimum of $5 or $10 million. With this fund, the minimums are only $25,000, and you can actually come in and out of these funds on a monthly basis. I will stress, though, that the liquidity is extremely limited. It's only 5% per quarter of the total fund size. So the total fund size today is about 900 million, let's call it. So we'd need to see 5% of that leave with any given month and no more inflows coming in for us to come up to the limits of that liquidity gate. Hopefully that all makes sense, but by all means, if there's any questions or anything you want me to dive into there, feel free to let me know.